Good morning and afternoon everyone, my name is Russ and here on DataDash today we have a special video where I would love to cover multiple questions that I received so far over the last few months in this channel about how to take trading decisions and how do I trade when it comes to psychology and decision making. Of course, I wanted to come up with the condensed summary of top 15-20 books that I read over the last 3 years, which are dedicated to trading and trading psychology. However, I decided to start with the one I like the most, because that's the one I am mostly asked which one you would recommend if there is one and only. I say Dr. Alexander Elder, The Trading for a Living, or The New Trading for a Living, and your edition of it. And before we dive into the context of the book, I would like to point out how remarkably interesting the history of the author itself is. He was born in Leningrad, which you might know by now as St. Petersburg in Soviet Union, and he served as a doctor on the ship that have been cruising all around the world as a medical doctor for the crew, and at some point passing by Côte d'Ivoire or Ivory Coast, he basically ran away from the crew. It was obviously illegal what he was doing, but he assessed his risk rewards and decided to ask for an asylum in American embassy. So a few months later, despite the crew of course followed him and the US embassy let him in, he found himself in New York, young, without any ability to speak English and with $20 in the pocket. And that's how the book starts. So from those you can already understand the degree of tolerance to ambiguity of someone who writes such a book. In the beginning of the book, he brings up the example of the guy who always wants to lose the weight, but all his friends remember him as being overweight. Why so? Because despite sticking to the diet, when he's being left alone, he cannot stand against an ability to get a nice big piece of cake. And that's very applicable to a lot of traders who do significant amount of work, very much prosperous in their ability to improve the technical analysis, working on the journaling and so on, but once in a while they jump into the self-sabotaging behavior and they literally gamble. And that example brings the three pillars of successful trading based on Dr. Alexander Elder. Those are: number 1, psychology; number 2, market analysis and trading systems; and number 3, rate management or risk management. So let's start with number 1, the psychology, and why it is so important. But before we even jump into the topic, I'd like to note from myself, I met so many traders, so many young aspiring traders throughout my career, my journey, and most of them do not have the lack in technical skills. Now think from the broader scope. If majority of people out there are not having any issues with understanding what an RSI, stochastics and MACDs are, neither they understand the idea of supply, demand and ranges, yet only 10% or even less of people are able to make money consistently in any market. What is it there that prevents all those with great technical skills to actually consistently make money? Of course, this is psychology, and that's why it comes as a number 1. This is also the reason why the people who just want the signals to trade, or the people who want to get a coach to build the trading system for them, are not understanding that you need all 3 legs for that chair to be stable. If at least one of them is missing, nothing gonna work, independently how great your self-mastery skills are, how great your trading system is, or how great your risk management abilities are. It does not matter if all 3 of them are not present. Coming to psychology, Dr. Alex Elder emphasizes the fact that it's very often as important and should take you as much effort to analyze yourself as much as you analyze the market. And that's actually the reason for me to step on this journey, because prior to trading, I already had a successful consulting career and retired pretty much at my 30. So what was there that brought me from a very comfortable living and ability to travel everywhere I want, being around 100 plus countries, having all the expenses, hotels paid by lovely clients, retentional ones, working with the smart people, a nice team, and key opinion leaders in their industry. What was there that brought me personally to the hardship of living for years on 5 minutes time frame, having multiple sleepless nights, and having no certainty whatsoever and what that's gonna bring me? For me personally, that was the journey of self-discovery, and I think that's the hardest thing in the world. Please write down in the comments below if you think there is something harder as an occupation or as a job to do. But for me, from my experience, that's one of the hardest things to do, because there is, on the one hand side, no one you compete against, a part of yourself, and on the other hand side, this is the hardest game to win it, because the barrier of entry is so low that you are literally trading against algos, institution, hedge funds that can afford employing the smartest people in the world with 7-digit salaries, and at the same time you are trading against anyone there possible. Take any other sport as an example. Where on earth would you start playing basketball, being a 4-year-old kid, and starting to compete against James LeBron directly? It's only possible in trading. No gender groups, no age groups, no experience groups. Everyone is against each other, and this 5-dimensional chess is what personally makes it so attractive to me, because only through that challenge I can understand myself better and practice self-mastery at the level that I would never be able to achieve in other more favorable or less dangerous conditions. And Dr. Alexander Elder emphasizes that point. So starting with psychology, we can of course have a whole hour of discussion about that, but if it has to be outlined to 6 key principles, those are following. Number 1, be realistic. That means if you have $50,000 saved and you want to go on full-on trading journey, of course you will be in a very tough place, and you probably need to think twice if you are yet at the point to fully quit your 9 to 5 and to go into the world of trading. So be mindful about it. Don't set yourself the expectations that would not be realistic. It is very important. Number 2, super important, and it took me 2 years and actually burned a lot of money until I started doing that. Keep the diary of your trades. Always analyze what was there in terms of your emotions, but also in terms of the technical setup that prevented you from success, or vice versa. Always validate and gratify yourself if you've done well, but please write it down. Every line. It can be simple Excel, it doesn't have to be fancy. Always keep the diary of your trades. Number 3, set up the rules before entering. This is unfortunately something I see all the time. People are thinking we are going up from here, and they enter and then they start seeing what's gonna happen if I'm wrong. Never, please guys, never put yourself in this position. And Dr. Elder outlines that specifically. Every time you enter the trade, you need to understand what is your risk and what is your reward, i.e. at which point you're comfortable to take the trade out, to take the money from the market, and stop thinking, should I be in there? Should I re-enter? How can I do that? So please don't be hard on yourself. This is a very, very hard thing to do. When your trade is bleeding, you start adding up to it. It's bleeding even more, and it's harder and harder to accept that loss. Number 4, if you are on a losing streak, you cannot make it this week, this day, or even this month, stop trading. Not being in a trade is an amazing trade itself. And I emphasized it many times in my videos, if you remember, over the last several months, that altcoin market is not the place right now for the swing trades, for example. So unless you want to scalp it on the intraday movements, be comfortable with not trading at all, either because the market is not at your favor, maybe because you used to trade only the trending markets and right now it's ranging, so you have a higher expectations for actually being chopped out. That's fine to say no. It's also fine to say no when you're tired, you're exhausted, your focus is not here, or you had a losing streak, so you need to get back to yourself, reevaluate your strategy, but most importantly, reevaluate your inner health, your mental approach to all of that, and mostly maybe even question yourself, why do I have to be in a trade here all the time? What causes that fear of missing out? Why do I feel incomplete? What is an amount of money that I need to make in order to be at peace with myself? And also one of the things why I personally love trading, because I love psychology and I love self-mastery and understanding myself. And I believe if you look at a Maslow pyramid and you start, of course, with the first layer, with financial, with material layer, but then you go more upwards in your self-actualization and you start understanding more and more about yourself through that first one. That was an addition from me. But yeah, I just wanted to emphasize how psychology is important. The rule number 5 from Dr. Elder: please don't count money looking at the trade. If you are in the trade and you are 6,000 and plus and you are starting to think, damn, this 6,000 is actually the new motorbike for me, those brand cool new motorbike, I should take it out, and you start imagining yourself driving this motorbike into the sunset on the coastal line. Guys, you are not trading by then. You are not focused, you are not mindful, you are not present. This is an indication that something is not right. And I gave you a good example. Imagine it's going in the opposite direction and you're losing the money, you're $3,000 for that trade negative, and you start thinking, this is 1 month of my work, this is the vacations for my kids. You know from which place you approach this trade already. You are in a very, very weak place. So please don't let yourself stay in those weak places. And rule number 6, please practice the sound money management. And this is somehow overlaps with the third key pillar, which is the risk management or the money management, and we'll cover it in the second part of our video. The second part of the book is related to the second pillar of the successful trading. And this is all about trading systems and oscillators. And there are so many oscillators in the world, but what's important from Dr. Alexander Elder's perspective is to separate them between the long-term trend indicators and the oscillators. And what's so important that you are trending alongside the long-term ones. Either it's going to be the moving averages or MACD. They're showing you how to pick up the direction, and we're going to cover it more in my trading course when it's going to be out later. That you see, for example, your moving averages are pointing to their number 2 on the clock, goes that way, and the trend is positive. And of course, it's more important to watch the longer term moving averages. That's why he emphasizes the necessity to have a bigger fishing rod to catch the bigger fish. So you would always prioritize your 800-day exponential moving average over your 200-day, and your 200-day over your 50-day, and your 50-day over your, let's say, 13-day moving average. And on top of that, he would always prioritize exponential moving averages against the normal moving averages, because they have the higher weight to the most recent data that has taken place. And then there are oscillators. This is another type of indicators that can be stochastics, that can be Elder ray, that can be any indicator that point out the fluctuation around, and you want to trade against them. So you want to be in when they're low and you want to be out when they're high, right? So that's also something very important to have those in mind. And the analogy that he brings is very useful actually. It's like you are walking with the dog. You would be the trend indicator, your direction, but the dog would oscillate around your move and would always normally come back and will oscillate normally with the standard deviation unless it sees the rabbit, and when it sees the rabbit it can actually print those 2-3 normal deviations, but always come back. And that's how the hedge fund trades, and that's how the institution trade. Very often, even on their website, at least there was on the website of Alameda Research before they collapsed, that one of their main strategies is the mean reversion, and that's how you can always trade around VWAP, volume weighted average price, for example. One last thing that Dr. Elder mentioned as a rule of thumb is to try to watch the related markets before making your decisions. So for example, if you're getting bullish on this particular cannabis stock, you want to see that the entire cannabis ETF or other competitors are also going with the same direction, so it does not appear to be a news-driven sell-off that would be following this move. If you want to go and be bullish on General Motors, you want also to see other companies to perform well. If you want to long pharmaceuticals, then you also want to see the entire sector perform. Right, that this is something that is quite evident, but he emphasizes additionally. And for all of those, to put all the things together, he introduces a special system, and he calls it the triple screen trading system. And in my opinion, it's actually very useful because a lot of traders, especially the younger ones, they hear a lot of statements here and there: trend is your friend, or buy low, or let your winners run. But then it's a little bit vague, so how to approach that? And for those people who surf, that will be a very interesting analogy, because Dr. Alexander Elder uses the 3 screens as the tide, the wave, and the ripple, which are correspondent to the huge moves on the markets, the fluctuations around those moves that, for example, would happen on a daily time frame, and then the little ripples, which would be the intraday movements. So what he recommends to do, for example, is to find a certain trend that can be, let's say, a deeply oversold RSI on the weekly time frame. So you would see that the weekly movement would start from here, and then you would like to find what happens within that particular day. You actually receive the red day within that larger move, and you enter long on the red day, not on the green day, making sure that the larger trend is still intact. And when to enter the position within the day, it is also very important. You are looking for breaks out on the hourly. Those are quite familiar, especially for people who followed my signals. Very often we were looking for the confirmation before getting long, and that confirmation actually also happens when we are breaking from the previous higher high, right? So first you see the positive move or the oversold oscillator, then you see the day which is red, and then within that red day you still would like that red day to start breaking out, and that's what he calls the triple trading system. In my opinion, it's quite useful because it allows you to think across various time frames, and it actually gives you a very good habit. And now comes the third part. When it comes to the third pillar of the trading by Alexander Elder, it all comes to money management. And within this money management, he emphasized that survival comes as a #1 priority, and only then the priority #2 is to have the steady returns. Then only if your returns are steady, you can have a tiny bit of focus on having those returns higher. And this is how you need to approach that. Because whomever you take, even Warren Buffett, he always emphasizes what happens if you lose 50% of your capital. It takes 100% to get it back from there. And it's unfortunately how many younger aspiring traders are getting burned out. They do not practice the 2% risk management system. And by this 2%, it does not mean that your stop loss has to be 2% below your entry point. That's very often how people understand it, unfortunately. That's why I'm emphasizing on that. 2% means that if you are invalidated on your trade, that only 2% of capital can be lost. It means if you're trading with $100,000, you cannot be wrong and lose more than $2,000 per one trade. If you're trading with $10,000, then you could not lose more than $200 per one trade, and so on. This is very important to practice, and in order to ensure that, he recommends to have the stop loss in place even before you enter the trade. And the stop loss can only be moved alongside the trade. So if you're long, your stop loss can only go up with your trade progressing, not vice versa. So very often what happens, your trade is start to go against you, it's nearly close to stop loss, you don't want that to be hit, and you start moving it slightly below, expecting the trade to reverse. That's not how you should approach your risk management. Most important also to keep in mind, especially if you're trading futures and you have a higher slippage on low liquid coins, for example. That's not from Dr. Alexander Elder, that's from Russ, but you need to account also for the brokerage fees, for the slippage, for the commissions. That all should be the part of those 2%, because otherwise you have a higher chance to get burned out. With all that said, guys, I wanted to get your feedback. If you like those kind of videos, I understand we have a lot of great books, a lot of wisdom to benefit from, but we do not all have amount of time sometimes to read them. So I decided to make the short summary of one of my favorite ones. I'd like to keep doing that. Please let me know in the comment section down below any feedback or which book you would like me to review. It's quite likely, if it's about trading or financial management, that I've read it or I would read it quite soon. So with all that said, let's maybe sum up what we spoke about today. So first of all, there's 3 pillars of trading, 3 legs of your chair, and you need all of them to use your chair. So psychology, market analysis, plus trading systems, and the money management. You can master and improve in one of them, but you have to make sure that another 2 are in place. Number 2, that you need to keep your emotions in check all the time, and it is as important to observe your emotions as it is important to observe the market. Number 3, there is no one perfect indicator to manage and master your trading, but you need to build up your own advantage, your own edge, to master a combination of them and see what works for you. Number 4, please, I highly recommend you to have this triple screen trading system in place when you observe it from 3 different time frames, and only when the highest time frame, the weekly time frame, is in a positive trend, but the daily time frame is getting negative, that's where you enter. If you enter on both positive moves, then you have a higher probability to get shaken out of your trade on the next red day. So keep that in mind. And of course, number 5, money management, risk management, strict 2% per trade rule. And with all that said, I wish you an amazing continuation of the week. Much love, and see you all soon. Bye.